Investors have a lot of headlines to digest these days. With stocks seeing higher volatility, many are debating their best course of action. As often occurs during moments of market uncertainty, investors develop a cloudy vision along with flashing sell or buy the dip signs. I get similarly confusing signals from my wife about what she wants to eat for dinner. To better understand what you should do when the stock market acts up, let's dig into what's happening, what it could mean for your investments, and what, if anything, you should do about it. So what's happening in the stock market? The ongoing forest fire that is the Omicron variant, along with the prospect that the Federal Reserve will hike interest rates to fight rising inflation, and Russia potentially invading Ukraine have all wreaked havoc for the markets. This is why you're seeing headlines claiming correction territory. For the past 30 years, inflation has been a non-factor. When I review a financial plan and reference that their monthly income is adjusted for inflation for their 20-plus year retirement, I get a deer in headlights look. In fact, it actually worried me that inflation has been too low. But during the last 9 months, that changes as inflation shot up faster than my waistline after Thanksgiving. The central bank essentially has two jobs: full employment, keep inflation around 2%. As inflation started to rise, the central bank reinforced that it was transitory. Transitory about as accurate as your local weather person predicting a snowstorm. The expectation was that inflation would decrease after a couple of months, but after 6 months of inflation moving above 4%, the central bank changed its tune and is now signaling that it'll hike short-term interest rates this year. Zero-rate short-term interest rates, accompanied by the central bank purchase of longer-term bonds, flooded the economy with cash. The loose financial conditions pushed investors towards higher risk and return profile investments, such as growth stocks and cryptocurrencies. Since the stock market is forward-looking, the central bank signaling that interest rates will rise this year led to a rapid stock market sell-off. So, what is a market correction? You're likely wondering where the market correction everyone keeps talking about comes into play. A market correction is when the stocks drop 10% from their most recent high. While the 10% trigger is rather arbitrary, it is a signal that investors are feeling pessimistic. When you think of market corrections, you might have flashbacks to overstocking on toilet paper back in March of 2020, the 2007 to 2008 housing crisis, or the dot-com bubble. It's normal. Our brains automatically go to the worst case scenario. We've been primed for self-preservation. We mentally go into survival mode and we try to prepare for Armageddon. Although fear is a natural instinct, it's not always logically appropriate for the circumstances. That said, this is a normal part of market volatility and can happen for a multitude of reasons. It's been almost 2 full years since the last market correction, so it's a bit overdue. On average, there's a market correction of 10% roughly every 18 months. There are many reasons that the market could go down, but also several reasons that suggest it could go up. As the New York Times reported, concerns that the Federal Reserve will move aggressively to remove the economic stimulus to fight inflation, fears of overarmed conflict between Russia and Ukraine, and rethinking of high valuations after a long bull market have all contributed to the rapid reversal. Here's what all these things have in common. They're out of your control. What investors should do as the stock market acts up? Seasoned investors who have ridden the ups and downs of the market roller coaster know that the best self-preservation technique is to focus on what you can control. One thing that is held true, the market eventually goes up. Now, if this dip has your stomach in knots, or you're thinking about putting all your money underneath your mattress, it's a good time to connect with your financial advisor and reassess your risk tolerance to ensure your current portfolio is the right one for you. Maintaining a long-term perspective is the key to riding out waves of market volatility. Your financial advisor should be your rock. We can settle your emotions, give you perspective on the situation, and counsel you through any action to take or not take. When the market takes a dip, we are proactive in reaching out to initiate these conversations. We can help you reevaluate how much risk you're taking and help you chart a way forward that keeps your goals and future wealth in mind. Above all, it's critical to remember that no investor or advisor can time the market. In fact, meaningful market returns are gained through time in the market, not market timing. Keeping historical context in mind, particularly the likelihood of market corrections as well as the uncertainty around shifting economic policies by the Fed, can help you weather the storm of a volatile stock market. If you're unsure about the risk in your portfolio or just want to get another perspective on your situation, I'm just a phone call away.